Market participants, including us at RCLCO Fund Advisors, continue to watch for the monthly CPI and jobs reports as though they were blockbuster movies of the year, with good reason, especially with the current backdrop of economic uncertainty. So diving in first to the CPI report, we had a little bit of good news in the May report. The headline inflation continues to cool. It's coming down. It was registered 4.1% last month, which is down substantially from the 9% peak last summer, although still running much hotter than the Fed's target. Zooming in over the last couple months, over the last 3 months, inflation has slowed though to an annualized rate of 2.2%. So getting closer to the Fed's target in real time. The caveat around that is most of this cooling has been driven by energy prices, which are down over 11% year to date. So stripping out energy and food prices, core CPI continues to remain elevated at 5.3% in May, year over year. And unfortunately, we haven't seen the same level of cooling over the last couple of months in core CPI as we've seen in the headline figures. Over the last 3 months at an annualized rate, core CPI is still up 5%. So the one sentence summary is basically that the Fed's aggressive inflation fight is having an effect. Inflation is coming down, but there remains work to be done, especially among core prices, and those really are continue to be driven by services, including housing. So we'll continue to keep an eye on that. Chairman Powell has signaled that the Fed does not consider the inflation fight over yet. Another important gauge for inflationary pressures is wage growth. This is coming out of the May jobs report. Wage growth has also been cooling over the last year or so and was down to 4.3% annual growth in May. This is the first time since March 2021 that wage growth has exceeded headline CPI inflation. So that's good news for workers. It's possibly raises some concerns from the perspective of examining inflationary pressures. This feeds into that services inflation that, as we mentioned, is driving that core inflation still. Over the last 3 months, continues to remain elevated. We haven't seen much slowing, and wages are up 4% on an annualized basis over the last 3 months. So elsewhere in the employment report, job growth surprised on the upside. May job growth came in at almost 340,000, which was pretty meaningfully above consensus expectations. And in addition to that, March and April job growth were both revised upward. So we still see the labor market's incredibly tight. We've had 1.6 million jobs added year to date. That's just through the first 5 months through May. And for reference point, from 2011 through 2019, annual job growth averaged 2.3 million. So that just goes to show that what an elevated pace of job growth we've seen this year still. Now, expected to cool, RCLCO's house view is that will cool, and we may even see job losses toward the end of 2023. But on an annual basis at the end of the year, we're likely to still see pretty meaningful job growth. Elsewhere in the employment report, the unemployment rate ticked up about 30 basis points, but it remains near its multi-decade low where it's been hovering throughout the year. So at 3.7 as of May. And the labor force participation rate has also been pretty steady throughout the year, moderately up year to date, but still meaningfully below where it stood pre-pandemic, about 70 basis points below. So overall, we're still looking at a tight labor market. Turning quickly to interest rates, the Treasury yield curve remains highly inverted. This is traditionally a predictor of a recession and tends to lead a recession by 1 to 2 years, depending on how exactly you measure it. The 2-year yield surpassed the 10-year yield back in July of last year. So we're coming up on 1 year of that inversion. And then the 3-month yield surpassed the 10-year in late October of 2022. So the yield curve suggesting that we are approaching the period when a recession looks most likely, at least based on what we've seen historically. Turning to corporate bonds, the BAA corporate bond yield spread to the 10-year US Treasury has remained healthy. So typically this spread increases concurrently with recessions. So the fact that we're still seeing a healthy spread from corporate bonds to 10-year UST indicates that the recession is not yet upon us. So taken together, we continue to see warning signs from the bond markets that the recession is approaching, if not imminent, but hasn't quite hit us yet. So wrapping up quickly, one more slide here on the federal funds rate, which, as all of us know, I'm sure, in May, the Fed increased the rate again to a range of 5 to 5.25%, and it held steady in June. However, it was a pretty hawkish rate pause. The initial commentary that came out suggested that future increases were still on the table, and then even more recent communication since then seems to suggest that future rate increases may even be more likely than not. So especially with that signaling, it looks increasingly unlikely that rate cuts will come before the end of the year. Most market participants are expecting rate cuts to begin early 2024, maybe even later in mid 2024. So that's very much what our house view is as well, that rates will continue to remain elevated through the next year and possibly start coming down in 2024 as a mild recession sets in.